So Ollie, we're familiar with the North American market, but are there events that are going on around the world that may have an influence on the pricing in Lloyd's and the capacity available in Lloyd's on a global level?
Yeah, and I think you can look at the reinsurance market on a global level, inclusive of Lloyd's. I think in the last 5 years, so this last decade, we've had more catastrophe losses, or catastrophe losses that have exceeded $100 billion in the last 5 years. And historically, when I first started out in the insurance market, you really looked at natural catastrophe as being hurricane, windstorm, and earthquake. But you move forward into today's world, and actually a lot of those the natural catastrophes are made up of flood, they're made up of tornadoes. It's a changing world from a climate perspective. I think this year we saw record size hail in Germany. And all of these things have an impact in terms of how insurance on a direct basis is priced, because ultimately they're backed by reinsurers. And I think that's been a big challenge that we've seen as a marketplace, particularly over the last 5, 10 years, is trying to understand and address climate change. And I think that's brought some uncertainty to the pricing. But going forward for 2026, I think the outlook is fairly positive in the reinsurance sector. On the back of some decent underwriting profit years over the last couple of years, more capacity coming in the market. And I think that is being attracted by the fact that we're using analytical tools to look at risks better. There's risk modeling out there. We're trying to understand exposure better, and to bring a certain amount of certainty into what I would say has been a relatively uncertain climate environment that we've been in over the last 5 and 10 years.
Yeah, and I will say, Ollie, in the 37 years that I've been dealing with, London, both on a contract binding basis and also a open market placement, the market over there has really changed. I mean, when I first started, there were hundreds of syndicates. And that kind of went through a shrinking phase where syndicates, bailed out, and the number of syndicates I think went down to just over 200 maybe. But there was still the capacity, so people were putting up more lines. And then, I think as more capital started coming in the market, some more syndicates and some London companies, insurance companies, jumped on board. So now it's, really a robust market with really unlimited capacity if needed.
Yeah, and I think there's underwriting discipline in Lloyd's, and
Yeah.
they have to, they have to respond to names. That's people's, own capital that they put up to back these syndicates, and also obviously the corporate capital that sits behind them. But I think a lot of it is coming down to the fact that greater use of technology in our business. Jim, you'll remember when we first started out, or when I started out 25 years ago with you, I don't think we had risk level data that was reported across to London, and now that data is really the bedrock of every single negotiation that we have on behalf of GenCap in the market. And that data is then reported through to those reinsurers. So it's all the steps and changes that we've made over that 25 years to better understand risk, better understand exposure, and help better price risk so that they can be more certainty and more capital deployed in that environment.
Jim and Tony, when you're listening to some of the global trends that Ollie alluded to, what are some of the things that you're seeing as a trickle-down effect with your ability to transact business in the E&S market right now domestically?
I think Ollie kind of hit the nail on the head with their, risk level data and, their analytical underwriting. They strive for long-term, success. So, even over in the U.S., they may be experiencing negative results somewhere else in the world, but they're looking at it on a global basis. So in our little microcosm, we feel a risk is a risk and this is what it's worth. But in the larger scheme of things, when Lloyd's is involved, I think they try to maintain a lot of underwriting discipline. So you don't see them jumping in and out of markets, and you don't see them, you don't see the rates, them undercutting rates. It's more, they're more analytical and they're more long-term. And I think, over here, you kind of, likes to hold the line on a lot of things. Sometimes you think the pricing's out of whack, but they have the factual data to back it up and what a risk is worth. So I think, over here, we kind of get the trickle down, but we're appreciative because we realize the experience and the analytical tools that they have, that most of the time their pricing is what the price should be.
And I think, Jim, it's fair to say we probably saw this over the last 3 or 4 years, particularly in your territory. The market changed. The domestic market's appetite changed, again, driven by the reinsurance capacity that was available to them. There was a number of people that pulled out certain segments of the market, particularly on the coast. And you've watched Lloyd's stand up more capacity behind your facilities in order that you're able to write that coastal and step in when others aren't able to offer that product. And that has been through utilising all 24 of your syndicate relationships that you have built over the last 40 years of trading with London and the trust and faith that those syndicates have in you guys to deliver the right price, at the terms that are required at that point in the market cycle.